Midnight in Emeryville, California. A man named Wilson has lived on his boat at this marina since 1997. In 25 years, he has never missed a payment. He never violated a policy. He never gave management a single reason to call. One morning, he opens a letter from a maritime law firm. The letter says he has to leave. When Wilson asks the harbormaster why, the answer is not noise or unpaid debt or a broken rule. The harbormaster tells him he wants to put a 62-foot catamaran where Wilson's boat is sitting. A newer boat, a bigger boat, a boat that pays more. The penalties for staying are $60 per day. Wilson is not a cautionary tale. He is the median outcome of what happens when the water beneath your hull becomes an infrastructure asset traded between private equity firms on Wall Street. In February 2025, Blackstone Infrastructure Partners announced the largest marina transaction in recorded history, a $5.65 billion acquisition of Safe Harbor Marinas, the largest marina and superyacht servicing network on the planet. The water you sail on is being turned into an asset class, and the buyers have run this exact playbook before. Safe Harbor is not a local marina operation that grew large through good service. It was engineered as a consolidation vehicle from the first day it existed. Founded in 2015 with private equity backing from Koch Real Estate Investments, American Infrastructure Funds, and Guggenheim Partners, Safe Harbor was built to aggregate independently owned marinas into a single scalable platform. The same architecture that private equity used to roll up apartment buildings, storage units, and manufactured housing communities during the decade before. By 2020, the network covered 101 marinas across 22 states with roughly 40,000 member boat owners. That year, Sun Communities, a real estate investment trust headquartered in Southfield, Michigan, acquired Safe Harbor for $2.11 billion. Sun Communities then spent 4 years expanding the portfolio and managing slip fee increases across the network. In February 2025, it sold Safe Harbor to Blackstone Infrastructure for $5.65 billion, booking an estimated $1.3 billion profit on a 4-year hold. The deal closed April 30th, 2025. The acquisition price represented 21 times Safe Harbor's 2024 funds from operations. That number matters to every independent marina owner in the country because it reset the floor on what marina portfolios are worth to institutional capital. Every operator with 10 or 15 marinas in a coastal market now has a Blackstone-grade comparable for their next sale. Blackstone is not a company that stumbled into the marina business by accident. It manages $55 billion in infrastructure assets. The firm built its track record in residential real estate by forming Invitation Homes in 2012, a company that became the largest owner of single-family rental housing in the United States before Blackstone sold its stake and moved on. The marina play follows the same structural logic. Identify a fragmented market where supply cannot be expanded, where existing customers have no viable alternatives, and where recurring rental income is contractually secured. Raise prices. Upgrade selectively to attract a wealthier tenant. Hold in perpetuity. With Invitation Homes, the process unfolded over roughly 7 years before Blackstone began selling shares. The company entered markets where rental housing was short and home prices had left working families unable to buy. It upgraded selected properties, raised rents across the portfolio, and captured the premium that came from owning the only available inventory in the zip code. Tenants who could not pay the new rate left. Their replacement paid more. The marina version of that sequence is already running. Heidi Boyd, the senior managing director leading Blackstone's infrastructure division, said in the acquisition announcement that marinas benefit from key long-term thematic tailwinds, including the growth of travel and leisure and population inflows into coastal cities. That sentence describes a customer. The customer is not Wilson. The difference between the housing play and the marina play is one of permanence. Blackstone bought Safe Harbor through an infrastructure fund, not a standard private equity vehicle. Infrastructure funds are structured to hold assets indefinitely rather than sell within a 5 to 7 year window. This is not a short-term extraction before resale. The pricing trajectory is the permanent operating model. But here is the detail: most coverage of this deal leaves completely out of the analysis. The reason Blackstone's pricing power is structural rather than predatory, and why that distinction matters far less than the framing suggests, is that you cannot build a new marina. The Army Corps of Engineers individual permit required to construct a new marina in U.S. coastal waters averages 18 to 36 months from application to approval. A California Coastal Commission review can take a decade. The Island Gardens. Deep Harbor project in Miami, a $1 billion superyacht marina on publicly owned Watson Island, required 14 years from voter approval to marina opening, and the upland resort attached to it remains incomplete more than 2 decades later, entangled in lease disputes and multi-agency permitting reviews. That is a single marina, and it is the regulatory landscape Blackstone is counting on never changing. Waterfront sites that would otherwise support new marina construction are being absorbed by residential developers, building condominiums and hotels, uses that generate higher returns per square foot and face shorter approval processes. When a marina closes and its waterfront is redeveloped, that slip inventory is gone permanently. The result is a market where the total number of marina businesses in the United States declined at a compound annual growth rate of 22.1% from 2021 to 2026, according to IBIS World. The closures are not being replaced. As of 2024, 89% of the roughly 11,500 marinas in the United States were still independently owned. That percentage is the acquisition target for the next decade. The supply numbers tell the rest of the story. 56% of United States marinas are operating above 95% occupancy. 26% are completely full, with active waitlists. There are now approximately 12 boats in the United States for every available marina slip. That ratio, 12 boats per slip, is not background context. It is the source of Blackstone's leverage over every boater who needs a dock. The former CEO of Safe Harbor, Baxter Underwood, described the dynamic in a published statement worth reading carefully. He said, "Theoretically, to boaters, the fact that marina supply is declining is a bad thing because there is less slip space." Then he added, "For those left owning slips, it is a great thing because there is more demand for fewer slips." He was speaking to investors. He was describing your situation accurately. When you own 138 marinas in a market where no new supply can be built, where demand exceeds capacity at over half of all existing facilities, and where the slip agreement contains a clause stating the company reserves the right to change membership terms at any time without notice, the pricing power enforces itself without any coordination required. That clause, reserving the unilateral right to change terms without notice, appears in Safe Harbor's current membership documentation. It is not a legal technicality buried in fine print. It is the operational policy governing every boater at every one of their 138 locations. The fee data across Safe Harbor's network reflects that policy in practice. In Rhode Island, where Safe Harbor controls most of the popular marinas along Narragansett Bay, boaters in community forums documented projected fee increases of 12 to 15% for the 2026 season. Forum participants described their situation plainly. Safe Harbor has created a near monopoly of marinas in the state, and the alternatives are either on waiting lists or substantially worse facilities. On the West Coast, liveaboard surcharges at Safe Harbor locations increased up to 30% with no stated justification. In one documented case, a 45-foot slip with a single liveaboard was running $921 per month for dockage plus $400 per month in liveaboard fees. Both charges were subject to annual escalation clauses buried inside the slip agreement. Apply a 15% annual increase. After 1 year, $1,321 per month. After 3 years, $1,748 per month. After 5 years, $2,313 per month. A slip that cost $15,852 annually in 2025 becomes $27,756 annually by 2030 before any emergency repair or hurricane haul out. The sailor on a fixed retirement income does not absorb that curve. The sailor with a 62-foot catamaran and a wealth management account does. That is the filter the pricing creates without any explicit age restriction or policy. The Southeast tells a sharper version of the same story. Slip fees along the Florida and Atlantic coastlines are rising approximately 15% annually at some safe harbor locations, driven partly by wealthy residents relocating from the Northeast who treat the new rates as competitive against their former home marinas. The sailor who has kept a boat at the same dock for 15 years does not benefit from that comparison. And Safe Harbor is not the only player driving the consolidation. Suntex Marinas, backed by Centerbridge Partners, now operates more than 100 marinas nationwide after completing a merger with Windward's Florida portfolio in March 2026. Centerbridge committed $1.25 billion in a joint venture specifically to fund new marina acquisitions. A potential sale of Centerbridge's Suntex stake has been discussed at a valuation approaching $4 billion, meaning Blackstone's $5.65 billion deal has already set a comparable that makes the next transaction easier to justify. KSL Capital Partners has hired advisors to sell its Southern Marinas portfolio at close to $1 billion. Bain Capital is running its third marina-focused alternative real estate fund, with $3.4 billion closed. More than 30 institutional investment firms are actively scouting marina acquisitions, according to Andrew Cantor, a managing director at Colliers International. The independent marina your grandfather kept his sloop at for 40 years is now inventory in someone's acquisition pipeline. The question every sailor watching this needs to sit with is whether the version of this story where institutional ownership improves conditions is possible, and whether it is happening at their marina or at someone else's. Blackstone's public position is that the capital will fund upgrades that independent owners cannot afford. That claim is not fabricated. Several safe harbor locations have received meaningful infrastructure investment, floating concrete dock systems with genuine storm resilience, and harbor dredging that kept slips accessible through seasons when water levels dropped. Bloomberg's June 2025 profile of the acquisition ran with the headline, "Wall Street's Blackstone is buying marinas, bigger yachts, higher rent." The subhead confirmed that boaters and marina observers believe rising slip fees are pricing out the middle class. That is the mainstream financial press acknowledging the friction. The friction is not between improvement and neglect. The friction is between improvement for one class of user and displacement for another, and Blackstone has made no public commitment specifying which class of boater at which locations gets to stay. The Emeryville eviction campaign is the clearest data point on how that question resolves in practice. Multiple liveaboards describe the notices as targeting older boats, vessels with visible maintenance needs, and owners who had been at the marina since before corporate ownership arrived. A woman rehabilitating derelict and abandoned boats received her notice. The man who had lived aboard since 1997, who had never missed a payment, received his. The marina retained a maritime specialty law firm to deliver the notices and enforce the $60 per day penalty for failure to vacate. Management declined to disclose the total number of evictions or explain the selection criteria. The pattern in Emeryville is not an anomaly. In Dana Point Harbor in Orange County, California, a private investor group proposed rent increases of up to 96% after taking over the marina lease from the county government in 2018. Boaters fought the increases in court. They lost. The argument that slip fee contracts are private commercial agreements and that boaters have no protected right to affordable access to a privately managed dock has held in the courts where it has been tested. What has not been tested, and what the coming consolidation wave will force into the open, is whether navigable U.S. waters can be made effectively inaccessible through a combination of private marina pricing and public anchoring restrictions passed by local governments responsive to waterfront property owners. Anchoring restriction ordinances passed in Florida, Georgia, and Miami-Dade County in 2024 and 2025 already limit how long any vessel can remain at anchor in designated areas without paying a mooring fee. Whether the waterfront real estate lobby and the marina consolidation wave are coordinated is a question with no clean answer yet. The timing is not coincidental, but timing alone does not establish coordination. That question belongs to the comments section of this video, because the sailors watching this are the ones with the most accurate real-time data on what is happening at their specific marinas and anchorages. The arithmetic of what you can do is straightforward. Public navigable water in the United States belongs to no corporation. Blackstone cannot buy the anchorage. The sailors who navigate this consolidation wave correctly are the ones who have already located the independently owned alternatives within their cruising range, audited the escalation clauses in their current slip agreements word for word, and built the coastal anchoring knowledge that puts them outside the reach of any private membership program. The sovereign sailor's position is not sentimental, it is mathematical. A 40-foot sloop at anchor costs nothing per night. The same boat in a safe harbor slip in Rhode Island costs $200 to $300 per foot per season, and that baseline is increasing at 12 to 15% annually. Over 5 years, the sailor who builds genuine anchoring competence and carries a working dinghy for shore access does not need a dock to disappear. That competence is the one infrastructure investment the private equity firms cannot acquire. The only monopoly they can enforce is the one you accept. 89% of marinas are still in independent hands. That percentage will not hold for another decade at the current acquisition pace. The window to choose your dock before it changes hands is narrower this season than it was last season. Drop the name of your marina in the comments and whether the ownership has changed in the last 3 years. You are the real-time data this community needs.